Today's lesson is about debits and credits and the double entry system. But before we begin with today's lesson, let us look what we did in the previous lesson. We discussed the accounting equation. Assets equals owner's equity plus liabilities, or just assets equals equity plus liabilities. We also discussed the list of account names that fall under assets, non-current and current assets, which fall under non-current, which fall under current. What is non-current, what is current? We also looked at which accounts fall under liabilities, non-current and current, which accounts are expense accounts, which accounts are income accounts. We also looked at when they fall in which categories. Today we're going to use this list. If you do not have this list in your head, then nothing I say in the next few slides is going to make much sense to you. You have to have this list in your head. Now don't try and learn it off by heart, as I said before. Read it through 10 times over every single day, and eventually it'll stick in your brain. Today we're going to use the list and see how the double entry system works. The double entry system says that for every transaction there must be two accounts affected. One must have a debit entry, an entry on the left, and one must have a credit entry. So let's say the owner contributes 100,000 Rand to start a business. When the owner contributes something, we know that the account involved is capital. What he contributed is the other account. He contributed money, so the other account is bank. So when the owner contributes 100,000 Rand as his capital contribution, the two accounts is bank and capital. We debit the bank with 100,000, and for every debit, we need a credit, 100,000. Let's say we take some of that money and buy some equipment. So we are buying equipment and we are using money to do so. So the two accounts is bank and equipment. Now if money came into the bank on the left-hand side, on the debit side of 100,000 Rand, and if we want to take money out, we will have to put it on the credit side. So let's say we bought equipment for 50,000 Rand. So we're going to credit the bank. Money in is on the left, money out should be on the other side, on the right. Now for every credit entry, we need a debit. So if the bank is being credited, the equipment account must be debited. Let's say that the business is going to borrow some money from the bank. So when we borrow money, it's a loan. And where do we put that money? We put it into our bank account. So the two accounts affected would be bank, which we already have, and loan. So if the money in side of bank was the left-hand side, when we received, let's say 20,000 Rand as a loan, we will keep debiting the bank. And for every debit, we need a credit. Let's say we pay some of that loan back, 5,000 Rand. Money in was on the debit side of bank, so money out is on the credit. So we will credit the bank. Let's say we pay 5,000 Rand back. So if we are crediting the bank, for every credit we need a debit. The loan account, if you have a look at it, it seems to be going up on the right-hand side and down on the left-hand side. Let's look at the bank account. Bank looks like it's going up, money in on the left, on the debit side, and money out on the credit side. Loan seems to be going up on the credit side and down on the debit side. Capital, capital going up, credit. Capital going down, debit. Equipment, more equipment on the debit side, less equipment on the credit side. So debit does not mean going up or down, as I've said before. It means the left-hand side. Credit does also not mean increasing or decreasing. It could be either. So therefore, the credit side is the right-hand side. Now you'll notice that the bank and the equipment account go up with debit entries and down with credit entries. The capital account, the loan account, they go up with credit entries and down with debits. How are you going to remember which accounts increase on which side? I've got an easy acronym for you. Bank is an asset, capital is owner's equity, equipment is an asset, loan is a liability. If you know your list, you'll know where they go. Let's have a look at this in a bit more detail. Debit, I said to you, specifically means left, and the credit means right. It is the Latin words, nothing more, nothing less. Now here are your two acronyms, DEAD and CLIC. What does DEAD stand for? The accounts that increase on the debit side are your expense accounts, your asset accounts, and your drawings accounts. They will go up on the left and down on the right. CLIC says, let's compare the two to each other. If D stood for debit, C will stand for credit. If the A in DEAD stood for assets, well then the L would stand for liabilities. If the E was for expenses, the I would be for income accounts. If the D was for drawings, the opposite of drawings, what the owner takes, is capital, what the owner puts in. So DEAD and CLIC, debit expenses, assets and drawings. Put it on the left of those accounts if you want them to increase, and on the right if you want them to decrease. CLIC says credit liabilities, income and capital. So if you want a liability or an income or a capital account to increase, you will credit the account. And obviously if you want it to decrease, you will debit. Let's look at that in a little bit more detail. Let's start with assets. It doesn't matter which asset account. If it's on that list and it's under the assets column, it falls under dead, which means they will go up on the left and down on the right. Or, if you want to speak debit and credit, it'll increase with the debit entry and decrease with the credit entry. Let's look at the other end, liabilities. They fall under CLIC. So therefore, credit entries will increase your liabilities and debit entries will do the opposite. Owner's equity in general will increase with credit entries. Can you see under the credits, under the CLIC column, you've got income and capital. Both are money coming into the business. Equity will decrease in general with debit entries. That is why under DEAD, the debits, you will see expenses and drawings, all equity accounts, decreasing the money for the business. Let's take that a little further. If you want to learn it just like that, that's fine. That'll really get you far enough. And a lot of teachers at the schools want you to do it this way. But I'm going to take it a step further and show you a little bit more. Capital is a CLIC account. So let's think about it. More capital, CLIC says credit the capital if you want it to increase. So more capital means more owner's equity, more money in the business. Income is also a CLIC account. Income will be credited if it increases. More income means more money for the business. Now so far, more is more and less is less. The only two that might look like the opposite way around and might confuse you is the last two. So if they do confuse you, stop there and just remember that everything else is a negative effect on equity. But let's go and look at this. Opposite of capital is drawings. Capital is a CLIC account. More capital is a credit. Less capital is taking money out of the business, which is then a debit. But we've got a name for that, so therefore we're going to call it drawings. Now drawings is a dead account, right? Dead says debit expenses, assets and drawings if you want them to increase. So more drawings is less owner's equity. Expenses also fall under dead. Think about this. The more your expenses are, the less there is for the owner. So more drawings and expenses means more money being taken out of the business, which then decreases the owner's equity or the owner's wealth. If you can't remember that, just stick with credits under equity will increase equity, debits under equity will decrease equity. So if you've got bad things, debit equity. If you've got good things, credit equity. Let's look at an example of how we apply DEAD and CLIC. We're going to use the same class example that we used in the accounting equation video. In that example, we only filled in the effects of each transaction on assets, equity, and liabilities. But in this video, we're going to look at which account do you debit and which account do you credit for each of these transactions. Our first transaction, the owner contributes 100,000 Rand to the business. First thing you need to do is identify which two accounts are affected with this transaction. The owner is contributing money, so the first account is bank. Where did it come from? The owner contributed it, and we call that capital. Now you say, right, where does bank fall in, DEAD or CLIC? It is an asset account, therefore it falls under DEAD. So we will debit expenses, assets, and drawings if we want them to increase, and credit them if we want them to go down. The owner is contributing money to the business. We are doing the business's books. So the business is receiving money, so the bank account is increasing. So therefore we will debit the bank. Capital account is owner's equity. CLIC says credit liabilities, income, and capital. So therefore to increase capital, you will credit the capital account and debit it to decrease. We are increasing the capital, therefore we credit capital. We've debited the bank and credited the capital. For every debit, we need a credit according to the double entry system. Let's go and fill this in on my accounting equation table. The account that I've debited is bank. The account that I've credited is capital. In our next video, we will continue with this example, working through each transaction, identifying the two accounts, determining whether they fall under DEAD and CLIC, saying which side they go up or down, and finding out which account you debit and which account you credit.